The requirements of the financial institutions are primarily driven by this challenge of flight to safety and not having a system and an infrastructure they can trust. So when you say the requirement, they say bring collateral, bring 7 years of 40% equity down payment or whatever. All of those things are because, again, they don't really know who they are looking at. They don't know the history, the true credit picture of that person, their credit worthiness, their income, and this is purely a data credibility problem. So we are not, the Nigerian problems are not, we are not inventing new problems, right? And I don't think that we have a genetic or natural propensity to either underachievement or fraud or any things that we think, oh, these are uniquely Nigerian issues. Other climes have gotten this right because by the time your credit behavior, your credit history is something that you can't escape anymore, people start to pay back their loans because they're trying to build your credit. If you, US, UK, China, they're terrified. People are terrified of ruining their credit because they know that that thing is what determines whether you get a house, whether you can rent a house cheaply, whether you can buy a car, whether you can get access to mortgage, whether you can pay your school fees. Just that one thing. So that is the first issue. I understand the challenge of interest rates, of course, and even now in a high interest rate environment, because the monetary policy of the country now is it's more contractual monetary policy that's trying to take money out of the system, and that's quite understandable. So of course the high interest rates are there to also manage portfolio investments. But these things are not perennial problems. Monetary policy ebbs and flows. Now we happen to be in a high interest rate, particularly high interest rate environment. But remember again that the reason why interest rates are high is because the financial system has to invest in figuring out ways to profile customers, having physical branches, having operational expenses that are lashed on top of the monetary policy rates to be able to lend to customers. We do believe that, yes, it's a journey, but we are not inventing consumer credit in Nigeria. And what we have seen, the data has shown that in the US, for example, the volume of credits, consumer credit that is being done is twice, in fact 3 times, so 2 times additional on their GDP. So roughly, if you take all the income that people are earning as a rough explanation of GDP, not that is a perfect explanation, but if you think of GDP as just how much money that people making in the country, aggregated, roughly, just rudimentary. People are living a lifestyle, buying things that are 3 times that. So if I earn $100,000, I live a lifestyle that is $300,000. I know that it sounds culturally like, why would you want to live above your means? But that's not the case, because remember that I am going to earn that money, that balance over my lifetime. I am just bringing the access to the things forward. And that makes the difference between being able to pay your school fees for student loan, having a home that is decent you can live in, having a vehicle. So the tragedy of being like a working Nigerian is that it's almost like your later years financially, your glory years or good years financially tend to be at the terminal point of your life. But
so why are you asking for how much they can pay in 6 months? I think I've gone through your form.
Yeah.
It's asking what can you pay back in 6 months. Does it mean that the kind of credit you're going to be given is something that can be payable in 6 months?
No.